A war in the Middle East does not need to reach your city to reach your wallet. It only needs to choke one narrow waterway, frighten one commodity market, and force one chain reaction through fuel, freight, food, and interest rates. That is why the latest Iran crisis is not just a military story. It is an economic story, and it may become an inflation story for the entire world. Over the past days, oil markets have been thrown into violent motion. Brent crude surged above $100 a barrel and briefly spiked near $120, while analysts began rewriting their forecasts in real time. The reason is not complicated. When traders believe energy supplies are at risk in the Persian Gulf, they do not wait for shortages to show up at the gas station. They price the fear first. If you look at a map, Hormuz does not seem large enough to shake the world economy. But for energy markets, it is one of the most dangerous pressure points on Earth. A huge share of globally traded oil moves through that corridor. If traffic through Hormuz is disrupted, delayed, or even threatened, the result is immediate. Shipping costs rise. Insurance costs rise. Delivery risk rises. Oil prices rise. And once oil rises sharply enough, everything built on top of energy begins to wobble. That is what makes this crisis larger than the headlines about missiles, retaliation, and diplomacy. It is not just about what is happening between Iran, Israel, and the United States. It is about what happens next to prices, to inflation expectations, to central banks, and to growth. That question alone is enough to lift prices. Traders, refiners, shipping companies, governments, and hedge funds all begin adjusting for uncertainty at the same time. Energy buyers scramble to secure supply. Shipping routes become riskier. Insurance premiums climb. Tankers slow down, reroute, or wait. A delay in energy is not like a delay in luxury goods. It hits the foundation of the industrial system. Oil is not just gasoline. It is freight. It is aviation. It is chemicals. It is plastics. It is fertilizer. It is manufacturing. It is road transport. It is power generation in many parts of the world. When oil climbs fast enough, the cost does not stay inside the energy sector. It spreads. A company paying more for fuel pays more to move goods. A factory paying more for inputs pays more to produce. A supermarket chain paying more for transport eventually passes that cost to the consumer. Airlines raise fares. Shipping companies raise rates. Food producers face higher fertilizer and logistics costs. And households, already squeezed by years of price pressure, feel the hit almost immediately. If oil prices remain high long enough, central banks are forced into an ugly position. Cut rates too soon, and they risk reigniting inflation. Keep rates high, and they continue choking growth. That is the trap. A geopolitical shock can revive the very inflation central banks have been trying to bury, while also weakening the economy they are trying to protect. That is why the market is not reacting as if this were just another regional flare-up. Analysts have already begun revising their oil assumptions. Major banks have raised their forecasts. The International Energy Agency has described the current disruption as the largest oil supply shock on record, and emergency stock releases have already been put on the table. That is not the language of a contained event. That is the language of systemic risk. In 1973, the Arab oil embargo helped trigger one of the great inflationary shocks of the modern age. Oil prices surged. Growth slowed. The West entered a period of economic pain that reshaped policy for years. Then came 1978 and 1979. Iran itself became the center of another oil shock. The revolution disrupted production, global prices jumped, and the consequences did not stop at the border. The shock fed inflation abroad, intensified economic weakness, and helped define the grim mood of the late 1970s. This is why the present crisis matters so much. It is not only a matter of who strikes whom, or what statement gets issued next. It is a test of how fragile the post-pandemic global economy still is. The world is already carrying high debt, expensive capital, stressed consumers, and politically sensitive inflation. That means the system is less resilient than it looks. The countries that suffer earliest are usually the heavy importers of energy. The ones that rely on foreign fuel, run current account pressure, or already struggle with inflation do not need a prolonged crisis to get hurt. They only need a few weeks of higher energy prices. Their currencies come under stress. Their import bills rise. Their growth outlook worsens. Their consumers get squeezed. Their policymakers lose room to maneuver. Industries feel it too. Airlines, logistics firms, transport-heavy retailers, chemical producers, fertilizer businesses, and manufacturers dependent on stable energy costs all face the same problem. Margins get crushed when costs move faster than they can raise prices. The first thing markets reach for in an oil shock is oil itself. The second is often gold. Not because gold solves the physical problem, but because it solves the trust problem. In moments like this, investors start asking which assets depend least on the stability of institutions, shipping lanes, or political cooperation. Gold becomes attractive for the same reason it always has in periods of stress. It is not a promise issued by a central bank or a government ministry. The recent surge in official sector gold buying around the world already reflected a larger trend. Countries have been reminded again and again that assets inside someone else's system are only safe until politics changes. A war that disrupts shipping and freezes confidence only reinforces that lesson. A portfolio can look diversified on paper and still be concentrated in one assumption, that the system itself will keep working. But what happens when shipping lanes are threatened? When payment systems become political weapons? When reserves can be frozen? When energy markets stop functioning normally? When the official price is no longer the real price? Markets do not break only when assets fall. They break when the structure holding those assets together becomes unreliable. Because once an energy shock is large enough, it begins changing behavior. Governments release reserves. Central banks delay policy shifts. Companies hedge harder. Consumers pull back. Investors seek safety. Importers panic. Exporters gain leverage. Growth forecasts weaken. Inflation forecasts rise. And the same crisis that began with missiles ends up changing bond yields, rate expectations, fuel costs, retail prices, and political stability far beyond the battlefield. Yes, not by itself forever, and not with the same severity everywhere. But the mechanism is real, the market reaction is real, and the vulnerability is real. If oil remains elevated for long enough, the pressure will not stay inside the Gulf. It will move outward through transportation, food, manufacturing, monetary policy, and consumer expectations. The world does not need another inflation wave to suffer from one. It only needs a sufficiently large energy shock at the wrong moment. Because in the end, wars in the Middle East are not only fought with missiles and warnings. They are also fought through shipping routes, energy markets, insurance premiums, reserve releases, and the silent tax of higher prices.